This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
CIMA E1, the finance function in the digital age. One of the aims of the syllabus is to try to generate within you what they call a digital mindset. Now, what's meant by that? It certainly doesn't mean turning you into computers. First of all, what's meant by a mindset? And as it says here, a mindset is a kind of set of assumptions, or perhaps set of tools, or well-tried and tested approaches that you may automatically go for when confronted with particularly an accounting problem. So we all have our go-to tools, our go-to methods of thought and so on. That's really our mindset. What CIMA means by a digital mindset is simply that it wants to elevate within your mindset, or to infiltrate into your mindset, the idea and the importance of digital technology in accounting. So that you are aware of the benefits and of course the potential dangers that digital technology can create. Now, McKinsey, which is a large firm of management consultants, looked at the skills needed by accountants and looked at the potential for automation there is within those skills. So this is looking at the potential for automation. And you see it goes down more or less steadily through this table. Data collection, think of that as really recording the debits and credits initially in the books of prime entry, if you like. Data processing is simple manipulation of that. For example, it could be creating an invoice, it could be creating an aged receivables listing of some sort. That's simple data processing. And of course, for many, many years, IT has played a very large part in those functions. As you go up the skill levels, and you could argue that the skill levels of doing debits and credits and producing invoices, producing aged receivables listings and so on, it's fairly low, fairly repetitive. As you go up the skill set, then we go to applying expertise. So applying expertise would be looking, for example, at two different products, two different projects, and drawing some sort of conclusion about which of these alternatives might be the most successful. It might be looking to see how can we increase the profit earned by a particular product. It might be looking to see should we open in a particular country. This is expertise. And these kind of decisions are not the kind of cut and dry decisions that are made, if you like, lower down in the functions here, which is much more programmable type decisions. Then we have stakeholder interactions, interacting with customers, suppliers, staff. And indeed even potentially interacting with governments and regulators and so on. And you see that in applying expertise and in stakeholder interactions, the potential for automation is very much less, as you would expect, really. But that may be changing. So as, for example, the techniques of artificial intelligence become more common, then there's no particular reason why maybe the actual decision making for should we make this product or that product, should we open in this country or that country, couldn't effectively be automated or substantially automated using artificial intelligence. Stakeholder interactions, well, who knows, it might be, we already, sometimes when talking to organizations, we are actually talking to a computer. It does voice recognition and so on, and it tries very, very hard to talk back to you in a way that seems human, although at the moment we can usually tell that it's not quite there. But that's only going to improve. But nevertheless, there's going to be this 20% potential for automation. And then managing others, the idea of inspiring people, like getting people to get behind an idea, of encouraging people to do what you want within a particular time line and so on. These are the set of skills which are least vulnerable to automation. Now the CGMA, that's a Chartered Global Management Accountant. And that organisation is a kind of joint venture between CIMA and the AICPA. The AICPA is the American Institute of Certified Public Accountants. A lot of what's in the syllabus is derived from various reports and suggestions that they've made. It looks at the competences the accountants might require. Nothing particularly surprising here. You need technical skills, and roughly speaking, I would have thought the technical skills are up here. And then you need business skills, and roughly speaking, the business skills are going to be kind of particularly in there, really. Some of these technical skills will come out a little bit, of course, as well there. But applying expertise, it's really applying expertise to do well for your business. The people skills really begin, I suppose, coming in here in the stakeholder interactions. And of course, the leadership skills coming in really in managing others. So that's there just to show a kind of correlation, if you like, between the McKinsey report and the CGMA skill sets, mindsets that accountants are going to require. Now, very briefly, we'll look at some of the digital influences. Many of these we will look at in more detail later, but it's just to, if you like, open up your mind already to the digital influence here. And first of all, we have something called big data. Big data is vast amounts of historical data held. Typically, it's held about customers for supermarkets, and it records what you buy, when you buy, what you buy with what. It'll record how your purchases may depend on the weather, how it depends on the time of year, and so on. It will record how susceptible you are to, a 2-for-1 offer and all this kind of stuff. Huge amounts of data are being collected nowadays, and the idea is that companies can then basically search through this data, looking for interesting bits of information that should improve their performance. Automation, you can easily go to Google or YouTube and look at film clips of automated factories, automated warehouses, where these trucks kind of sail around the place, never bumping into each other or into staff, transferring goods and materials to where they're wanted. 3D printing. 3D printing is sometimes called additive printing. This is where you can print a 3D object, a solid object. You put one layer on, then you put another layer on, and so on. And broadly, it kind of builds up as almost like a series of sheets. A series of kind of sheets here. And of course, you can begin to make it get smaller and smaller and smaller. As you get up there, you can make it hollow. You can have kind of bits coming out from here and so on. So this is very, very useful indeed for creating prototypes one-off. It's quite slow at the moment. Creating one-off prototypes, but cheaply, or perhaps creating spare parts where the production of spare parts is actually stopped and will run out of inventory. Artificial intelligence, big things hitting the newspapers and so on. Algorithms which are capable of beating chess grandmasters, algorithms which are capable of playing Go to a world championship level, and so on, using artificial intelligence techniques. And this is not where they have been taught by someone, but where they effectively learn themselves and work out the proper approach themselves. Connectivity, for example, connecting salespeople on the road back to head office. They can upload orders, they can look at inventory, and so on. We can look at the connectivity in factories. You could have something in the warehouse which weighs the number of units still left, and then when the weight has decreased sufficiently, it says, right, we need to order some more of those. And again, a routine transaction is taken out of it. Automatically an order will be placed to replenish that stock. And social media, the Facebooks, the Instagrams, the Twitters, and so on, hugely important in marketing, hugely important in actually gathering big data about people's habits. Now, the traditional shape of the finance function was triangular. So basically what you would have in many organizations is you have your kind of chief accountant here, and then maybe you would have under this person a kind of financial accountant, and maybe a management accountant, something like that, maybe a treasurer. And we'll see in the next lecture what these functions are. And then each of these people would kind of have their teams until you get down here to a large number of people who in a way are doing fairly simple repetitive tasks. And at the top it hierarchies up, if you like, as you get through the management structure. That was divided up a little bit later by what was called a segregated triangle. And all we're saying here is that many finance departments went through a kind of transition where the top jobs, if you like, tended to be in-house. And these ones here were very much outsourced. Not all, of course, but it was common to outsource the preparation of wages and salaries. It was common to outsource the maintenance of the receivables ledger to companies like factors and so on, because it was outsourced to companies who were extremely efficient, very large installations, and could look after these essentially pretty routine type of bits of processing more efficiently, faster than you could do in-house, and then that data would be transmitted in-house where the people higher up the hierarchy here could make sense of it and make their business decisions. Now, CIMA is very convinced, and again from CGMA, that the shape of that triangle is no more, and they've gone for this hexagonal shape. Now, if you think of the old triangular shape, it would have kind of come down here a bit, wouldn't it? So we can create the old kind of triangle like that, and it would have kind of pointed up at the top here as well. So what's been lost here to get to the hexagonal shape is firstly lots and lots of people at the bottom here. All of these people here who were engaged with assembling, collecting, processing data in a very routine way. Basically their jobs have gone or will go very quickly, because this is the stuff which is the easy win for information technology. Even a little bit further up the levels here, if you like, kind of supervisory level, perhaps, a lot of those jobs will go. There might even be simple management jobs there, but simple management jobs where there's kind of yes, no, fairly easily programmable decision coming out. Should we extend credit to this person? Well, what's their credit score? And the computer makes a decision. And you may have come across this if you've been pursuing any sort of loan for a car or something like that. It's piled into a computer, and then the dealership can get their answer back in a few seconds as to whether or not you reckon to be a good credit risk. It's not a person deciding on that. So even further up here, further insights in your area of specialism, whether it's credit control, whether it's deciding how much inventory to have in stock at any particular time, a lot of that is going to be subject to automation as well, and those jobs are going to kind of contract at any rate. Where we get the bulk of the people here is what they call this partnering for value, to influence and shape how the organization creates and preserves value. And basically this is your business decisions. Partnering for value. This is remember the role of the finance department here. We're looking not at the company, in this diagram, we're looking at the finance department. So we're saying, how do people in the finance department partner for value? And it would, for example, be by maybe creating some sort of spreadsheet which enables people to plug in certain assumptions to decide, should we make this product? Or what type of supply is best? Should we have it supplied outside? Should we make it in-house? And so on. What sort of price should we charge for this? If you've got some information about how price and volume are going to be changing, then we can give information maybe to the marketing department. Yes, you could add this feature. It will add on 10 cents per unit. But if you add on this feature and it costs you 10 cents per unit, but you can add the price on 25 cents per unit onto the price, then of course you're going to be coming out ahead of the game. So this is really looking at the business decisions. What decisions should be made to maximize in a profit-seeking organization, to maximize the profit, in other organizations to maximize, in a way, their efficiency and effectiveness. And then at the top, leading the finance team, you see it's got this flatter top here. And I think what that recognizes really is everything's got more complicated. Financial accounting, financial reporting is very complicated because of all the accounting standards. Treasury management, looking after foreign currency transactions and so on, futures, options, complicated hedging mechanisms, is a very skilled operation indeed. Even management accounting is more complicated than it was. There are new management accounting techniques come out from time to time. They're not that new now, but activity-based costing, throughput accounting, and so on. From time to time, the methods of producing management accounting reports are going to be changing. So rather than having perhaps one person at the top, what you maybe have up here is your chief financial accountant, your chief management accountant, the person in charge of treasury and so on, and they have to kind of cooperate and liaise much more rather than one person being in control of everything. So the upshot is, instead of the triangle, we get this what they call a hexagon here, six-sided item here. And remember, it's the people at the bottom. If we go back up here, the people at the bottom here, it's essentially these ones here. They're the ones who are going to be losing most of their jobs or having to be retrained and so on here. We're going to be keeping an awful lot of people still in here. And managing others is going to change a little bit because we maybe need different sorts of expertise in managing people with different skills. The change in the structural shape has been driven by, first of all, changes in the role of the finance department. It used to be that the finance department, is almost its primary objective was to produce the annual financial statements for the shareholders. And then people began to say, well, that's all well and good, but producing financial statements showing what happened like a year ago is not going to help us survive in the future. And there has been a considerable change in the, if you like, the balance of, not so much the balance of power, but the balance of importance between financial accounting and management accounting. It's kind of gone like that. So much more much more emphasis on management and management accounting, less on financial accounting. And this, because financial accounting is very kind of repetitive, very debit, credit, do the reconciliation, debit, credit, and so on. Management accountant is open-ended. You have to invent whatever reports, whatever calculations you feel are going to give insight to management. And secondly, technology. Technology means that more and more routine processes, even not so much routine processes, are now automated, and we don't need as many people doing the basic repetitive tasks.